Hello and welcome to the next Equity Masterclass video, which this time is on an overview of equity securities. Now, we've already had one overview module. This is the next one, and its job is really just to make sure that everyone is aware of how shares work. I remember this one coming into the curriculum, and it was just to fill that gap and to make sure that no one's left unaware of what a ordinary share is or what a preference share is or preferred stock, and that everyone understood the key features. It also brings in a section on how we can invest in overseas companies, so non-domestic equities, which has got quite a lot of techie detail in there, but it all makes sense when you understand why we need this really in the markets. And then we've got the often confused return on equity and required return on equity. The first one being an accounting measure, the second one being a discount rate. Okay, so let's get into the details. So we've got a big table here with lots of stuff on it, which basically takes the two main types of things we would call shares or stocks. Okay, got to use those terms interchangeably. Which are common stocks, also known as ordinary shares. Or if we were being sort of precise about it, when we talk about equity, it's these things that we are talking about. Preferred stocks might be described as a class of equity, but if you're using equity in its purest term, you're really referring to ordinary shares. Preferred stock or preference shares, often met first by people when they play Monopoly. They're a very narrow version of shares, and in the purest sense of the word, are not really equity. They're actually more like bonds, but without the legal basis of bonds, i.e., if you don't pay your interest, the lender can take you to court. It's not quite the same with preferred stock or preference shares. So let's just run through the basic features, make sure you're happy with these. Most of them are fairly clear, a couple of just need pausing on. So the assumption is normally that shares give you the right to vote, be that in person at the annual general meeting, AGM, and companies have to have those, or by proxy, i.e. by allowing someone else to vote on your behalf, or maybe you fill in a form if you can't be there in person. And it's corporate governance rules that make sure that these rights are upheld in particular companies. Now, cumulative voting is a speciality which I think, certainly have never seen this in the UK, but it seems to be a speciality that can help minorities by, so it's available to minority shareholders only, to basically allow them to group together all their votes. If they're voting for directors, for example, they can group their votes, and rather than casting one vote for each of 5 directors, they can sort of group their 5 votes and cast them for one director. It just basically allows minorities that otherwise would feel very unrepresentative and like their vote didn't count, allows their votes to just have a bit more weighting. But the basic idea is it's there for minorities. It's not something that the majority shareholder, let's say, with 50% of the company, they can't claim the right to use this. Now, there may also be different classes of equity. So if you are buying a share, you've got to make sure you know what other shares exist. In the past, it may have been more common that it was just one class of share. But now you might have, say, Class A and Class B shares. They may or may not both be listed. It may be that only one of the classes is listed, and they may have different rights to dividends, or more commonly, to votes. So a good example of this is Meta, which has Class A shares for ordinary investors and Class B shares for Mark Zuckerberg and a few others, but he controls them, and they've got 10 times as many voting rights. So if I get my percentages right here, he holds 13% of the equity, but has over 54% of the votes. Now, certain parts of the world have not been too keen on having different classes of shares. London, for example, has never really liked this idea of having different classes of shares. but they've kind of come round to it recently. It is a lot more common. Basically, buyer beware, what rights do you get with your shares? So dividends are at the discretion of the directors, and they cannot be taken to court to be made to pay dividends. But of course, directors are up for a vote periodically, be that annually or if they're on rolling contracts. So the directors' jobs are not secure. And moving down towards the bottom, we say that shares, ordinary shares, have a residual claim on the assets, which means once everyone else has been paid off, the shareholders get what's left, which if the company has been a success is a lot. If the company is being wound up, put into liquidation, it's bankrupt, that's probably nothing. So the shareholders are taking the risk, but they get in the good times the return. Preferred stock generally doesn't have voting rights. That's the usual rule. There may be exceptions if their dividends been missed for many, many years. They may get some voting rights, but the general rule is no voting right for preferred stock. The dividends fairly dull. It's a fixed percentage of the par value. Cumulative dividends means that if they're skipped for a year, they're not forgotten. And those skipped dividends kind of wait in the wings, and no ordinary dividends can be paid until the arrears is cleared. So that would make a preference shareholder feel a bit better if their dividend was missed for a year. Participating means there may be a formula behind the dividends, which means they get some of the upside in a really good year. So they might get a higher dividend if a certain target is met. They may go on forever, or they may have an end date. They may have options with them, like they might be convertible into ordinary shares. They might be callable, which means that the company can pay them back at will, or they may be puttable, which means the investor can demand their money back at will. The latter, not so likely for obvious reasons. So they're not as interesting. As I say, they're not truly equity. You basically are getting a return through the dividend. Okay, now how do we invest in companies that are not in our country? Well, capital markets are a lot more fluid these days, but it still can be hard to cross. There could be tax issues, there can be currency issues, there can be all sorts of transaction costs. So if we just wind the clock back 100 years or so, and take the situation where you've got US investors. It was the 20s. It was not quite the bad end of the 20s. There was money floating around in America looking for a good home. You had companies like in the UK. The first time this was ever done, it was Selfridges. Okay, top end food and other things retailers. And so Selfridges was looking for money, and the US investors had money, but the practicalities of a US investor investing in Selfridges shares was pretty much too much, and the tax and all sorts of restrictions on currency flows. So I'll call them JP Morgan. It wasn't JP Morgan at the time, but they popped up and said, we can cope with the practicalities of investing in another company in the other side of the world. We might even have loads of sterling sitting around that we could use for just that means. So JP Morgan said, we will buy the shares. In Selfridges, and we will lock them away in our deposit, and we will issue a certificate of ownership that relates to those underlying Selfridges shares. But we are not selling the shares on to you. We are selling, says JP Morgan, we are selling a certificate that says you have the right to a certain number of those Selfridges shares. And we will call this a depository receipt, and it will have a ratio. For example, you have beneficial ownership to 10 of those shares. So far, so simple, although it's actually, because of doing this, some interesting things come out of it. So those shares have a share price that is in pounds, but they've been locked away, And what JP Morgan do is they issue a certificate which trades in the US in dollars. Okay, so obviously foreign exchange kind of gets factored into the price, but those depository receipts for 10 underlying Selfridges shares are trading on a US stock exchange, so it's familiar. They just go and, US investors go and buy and sell these things, and it's in the right currency. So as long as we trust JP Morgan, then, this is great. So Selfridges gets a load of money and their investor is JP Morgan. They pay their dividends, by the way, to JP Morgan. They're in pounds. And there will be a legal contract between the investors and JP Morgan, terms and conditions about the depository receipt, which says that JP Morgan will pass on, if not exactly that dividend, something that feels like it, to the investors. When we ask who gets to vote, things get a little bit muckier. And the answer is, it depends. And it depends on the exact detail of how this has been set up. Okay, so let's go back to the slides here and let's see where that detail, it's all kind of down the bottom of the slides there. So yes, it is possible. Obviously that was like 1920 odd and things have changed, but it's still a bit tricky jumping those international hurdles. So these depository receipts basically allow us to bypass the direct ownership of the shares and instead own a certificate that represents those shares. Okay, so the first 3 bullet points there hopefully are nice and clear. You can have GDRs, which the G is global, and you can have ADRs. Okay, so the ADRs are specifying American. GDR is not traded or not US issued. So London is a big centre for the GDRs, so they're just not US issued. But basically, we're splitting hairs a bit there. Sponsored or unsponsored is how involved the company is. So Selfridges, in the original case, if it's sponsored, then they've given the go-ahead to this. They're part of it. They know it's going on, and they will pass on the votes to the depository receipt holders. Whereas unsponsored is kind of, it's happening without the involvement of the underlying company. Okay, so sponsored is getting a little bit closer to the overseas company. And then we're moving into the US regulation here. Remember, it is an international exam, so I don't expect them to push too heavily on this, but to be aware that you have got these 3 levels, okay? And as you move up the levels, so from 1 to 2 to 3, you are increasing the regulation. You are increasing the ability of the overseas company to actually raise finance. So by the time you get to a level 3 SEC registered depository receipt, ADR most likely, then you have got, let's say, the likes of Selfridges actually issuing these things into the American market to raise money from American investors. Whereas a level 1 is just more that these things exist and they will be traded by American investors, but they're not so much used for fundraising. So everything increases as you go up the levels, right? Whether they're listed, whether finance is available, more regulation, that sort of thing. Whereas Rule 144A, not one of the levels, that's kind of an unlisted version of these. And they're really for the big and knowledgeable investors only. So they're for the qualifying institutional buyers there. They're the big guys who know what they're doing. It's not a retail listed version of a depository receipt. Okay. All right, so the presence of them, I think, makes perfect sense, and the practicalities of them are just using that in-between bank to make these things work. Okay, in that case, JP Morgan, and the trade continues, and they are a big deal. So moving on, we've got the return on equity. And remember, I said there's two return measures that can get confused. So we meet the first one here. So as an investor in shares, you might be very interested in looking at the accounts of the company. And the accounting return on equity lets you look at, you could call it the income statement, the P&L. It basically looks at the bottom line, the net income, the profit after tax. And after any preference dividends, even if there's any of them floating around, most companies don't have preference shares, but they exist, but most companies don't have them. So the accounting return on equity looks at the bit of interest to the shareholders from the P&L, which is the bottom line, after everyone else has been paid, because that's where shareholders live, over equity. Equity in the accounts, you've probably done accounts, but if you haven't, or if you're hazy on it, equity is, let's say you've got total assets of 100 and you've got total liabilities, current and non-current, of 80, then the net assets of that company are 20. Total assets less all your liabilities. And if you went from looking in to the funding of the company, you would also call that the shareholders' funds, i.e. the share capital and all the reserves. So net assets, shareholders' funds, equity. Accountants love three words or three terms for the same thing because it confuses everyone else who's not accountants and it makes them look like they know more. So net assets, shareholders' funds, equity basically comes from the balance sheet, or what we should call, if you're in international terminology, the statement of financial position. So it's a ratio that just tells us, as you're probably aware, as you've probably seen before, the net income over the equity. Everything coming from the book values, i.e. what it says in the accounts, not what things are worth in the market. So it's fundamentally probably one of the most important and watched ratios. It could be increased by making the equity a smaller proportion of the company. So in our company there, what would happen if they said, actually, no, we want some more long-term debt. We might borrow some money and buy back some shares. Well, you'd see a reduction in the equity, but the company's still the same size. So the ratio can be manipulated by gearing up, i.e. increasing the debt. But of course, improving returns usually comes with extra risk. Management accounting choices can impact values, so depreciation policies and things like that as well. And this also overlaps heavily with what we've learnt already in accounts. So it's not really saying anything new. Similarly, the DuPont formula, it's not new, but it pops up all over the curriculum. I know when I did the exam, I felt that DuPont was a very important thing to learn because I would get credit for it in all sorts of places. So we'll look at that breakdown, and what you might want to do right now actually is, before you look any further, is just check that you can do that three-way DuPont breakdown. So return on equity, can you break it into its three parts? And you can actually then push it further and break it down into its 5 parts if you wished. So that's your return on equity. Now, one part that comes into it, obviously, is the book value of the equity. And that's basically from historic accounting, isn't it? And another thing we might do as equity investors is compare the equity in the accounts. So the book thing is basically the equity in the accounts to the market value of that, which of course you could do on a per share basis, one share, or you could do it for the whole company. So if you've got a big price to book ratio, it means that the market price is high for the underlying assets or net assets of the company. And that's because what investors are buying is not where the company is at the moment, but where they think it might be in the future. And it might be interesting to just Google to get an updated version of Tesla versus the likes of Ford or General Motors. And when I looked, Tesla had a price to book ratio of about 17, even higher. So the accounting value of the underlying net assets versus what people were paying for that through the shares, 17 times bigger what they were paying than what the account said. Whereas the traditional motor manufacturers were hovering around about 1. So I think it was 1.4 for Ford and less than 1 actually for General Motors. So the market was saying this company's not even worth what we could get if we stopped the production lines and sold the machines and the part made and finished cars. It's not even worth any more than that. So all of that is looking at the shareholders, sort of the external shareholders' views of the accounts and how they look at the return and also the link between the market value of the shares and the underlying equity or book value of the shares. So I asked you about the DuPont system. Hopefully you can remember this, very important. So you take your net income over equity and you can break it down into one that lives entirely in the P&L, net income over revenue, okay, which is basically a margin, net profit margin, and then your revenue compared to the equity, which on itself isn't used very much. So we split that one down into 2 and you get 2 ratios that are used a lot. Revenue compared to total assets, because that's telling you how much you are using your asset base to generate sales. And the second one, which is telling you about the leverage or the gearing. So what's your asset base relative to the shares? So if all of those go up, it would increase your return on equity, but we do have to be careful. Are we sweating our assets? So not updating our assets enough, or are we gearing up too much debt, which would show up in the leverage? Anyway, the mechanics of it are important. So that's helping us with return on equity. What about the one that is the other thing that sounds a bit similar but is different? The required return on equity. Total different job here. It's a discount rate. It's when shareholders look at what they're getting from the company and think, what's that worth to me in present value terms? So the cost of equity is often used as an internal to the company measure. What's it costing us to keep our shareholders happy? For example, as a percentage, 8%. So it's like an interest rate, but what do we need to give our shareholders through dividends and growth to keep them happy? 8%. And that comes from the investors saying, I will buy shares in your company, but I'd like an 8% return every year on my investment. So they are the same. There's no tax that gets in the way and makes those different. It's used as a discount rate. And we'll meet that in a later module when we start valuing companies, because we're going to be doing some present valuing of things. When you present value things, you need a discount rate. So present value of future dividends links to the share price. We'll see that later. Now, so what if we don't generate enough of a return to keep our shareholders happy? Well, one thing, the directors have failed in their duty, because I think directors often forget this, but their job is to look after the company for the shareholders, isn't it? They are the agents of the shareholders. And if they're failing to generate what the shareholders want, then the directors might lose their jobs, might be voted out. So they have a duty to think about their shareholders. And if they continue to fail to generate a return, the share price will fall. Again, so what? Well, that might stop the company from getting finance, either through shares or through bonds. So you can't have a company that just keeps failing to generate what it needs to do to keep its investors happy. Because at some point, those investors will be unhappy, they'll walk away, and there will be no new investors to take their place. So that could be the start of a downward spiral. That could be the end of the company's life. So it could be bad news. So the cost of equity, we will meet later in other parts of the curriculum, estimated through various measures, which you will see, so don't worry. but they're basically using observed inputs to work out what is a reasonable return for the shareholders. And it also links in with doing NPV calculations when we need to discount at the weighted average cost of capital. So this isn't really where we meet the return on equity properly. It's more that we go, there is return on equity from an accounting basis, which is what DuPont tells us. And then there's external investors saying, I want a certain percentage return each year. And that's your required return on equity. It's a discount rate. It's also known as the cost of equity. So the final slide here just sweeps up a few additional points, really thinking about what we mean by private equity, which again is covered in alternatives, also at other levels. So it's more of an introduction here. Sometimes company directors get fed up with this constant spotlight and short-term focus from analysts and investors. And they might say, look, I need several years to make this strategy work. I can't keep updating every 3 months how things are going. And I remember Richard Branson, head of Virgin at the time, Virgin Atlantic, took Virgin back private because he was fed up with being listed. And he just got really annoyed with the short-term focus. And it's only recently, as I record this, that the first edge of space flights have been undertaken from his company. And maybe it's because he was able to focus on the longer term without the investors constantly getting involved. Now, obviously, things have changed in companies' ownership over the time, but it's that kind of idea that it can sometimes be better to be away from the glare, the spotlight of the short-term analysts' investment focus. And of course, fund managers often have to present their returns on short-term basis as well. So everything's so short-term. So if there's a big pile of money that's willing to invest in companies with a longer term focus, then maybe it makes more sense to be private. So there will be no market listed share price, but the venture capital institutions, they've got pots of money that they can invest. There might be management with access to funds who might take part of a company private, but they're going to have a lot of debt to support them in that because they probably won't have enough money themselves. So management buyouts or leveraged buyouts, just meaning there's a lot of debt involved, could be other ways of taking a part of a company private. Or it may be that the shares are listed, but there's a slice of them, a big chunk of them, that gets privately placed to an institution, for example, at a discount, perhaps to the market price. So they're not really the normal traded versions of the shares. They're a private placement. So that's a private investment in public equity, also known for obvious reasons as a PIPE. Now, private companies don't always want to stay private. They often want to go public again, but after they've had time to sort themselves out, and again, away from the glare of publicity. Okay, and that ends that module. Which again is a bit of a background one, isn't it? Understanding how shares work, filling in a few gaps, maybe thinking about the overseas aspect with your depository receipts, etc. Okay, so I hope that was helpful in preparing you for the exam in this module.